Hello everybody, this is David Best with Agilon, and this is the webinar on planned giving. Today we're going to cover some basics of what planned gifts are about for those of you who aren't intimately involved, and also talk about how Agilon's One supports those types of gifts. It's a general overview and not intended to be comprehensive. There's quite a lot of detail to planned giving, as you see. And I'm also not a lawyer, which planned giving gets quite involved with legal setups. But hopefully we'll give you a feel for it and get you started on a path to success with planned giving. Start with some basic types of planned gifts. An outright gift is the simplest type, and to make it a planned gift, that's a gift that's planned to occur in the future, generally through an estate and generally after the donor's passing. Stocks and bonds, in addition to cash, of course, are fairly common. Assets like real estate, art, antiques, really any kind of property with value can be passed through the estate as a planned gift. And even retirement fund assets can be passed as a planned gift, as with anything that the donor owns at the time of their death can be passed through their estate. Another type of planned gifts are trusts that are set up to manage assets, generally before the death of the donor, and can be revocable or irrevocable, meaning that they can be rescinded at some point or not once the gift has been established or the trust has been established. You can also designate these types of gifts as restricted or non-restricted, which are all important points in setting up the planned gift and the legal documents around that. We'll get more into detail on types of trusts and how those work momentarily. And the third type, annuities and variable assets, meaning that there is revenue being generated from the planned gift at some point or during the donor's life, and then in some of these cases the assets can transfer to the charity after their death, but in the meantime the annuity stream or the value being generated by the gift is dealt with. And finally, life insurance, which is, as you can imagine, is the benefits of the life insurance policy being the gift itself. There's real benefits to donors to give to nonprofits through planned giving. Estate taxes can be quite high. I believe something like 50% of estate assets at some levels can be taxed as part of estate handling of the estate after the donor's death. And by not having to pay those types of taxes, the donor can establish a much larger gift to the nonprofit than if the estate taxes were paid prior to a gift being made, or even as a direct income tax deduction during the donor's lifetime. So there's really an opportunity for donors to make a much more significant contribution to your organization through planned giving. The capital gains tax is another advantage by passing these assets through their estate and to your organization without actually selling them. The gains taxes are typically not a liability against those assets and can be 20%, possibly more, of those values, and that can pass to your organization directly as as the quantity of the gift. With annuity type giving, the donor can retain income from the assets while they're alive and still gain the benefit of that, but give the assets in the end to the nonprofit organization. With assets that have appreciated significantly, where capital gains, of course, comes into play, by donating those types of assets through planned giving, they don't have to be sold, and so you don't have to convert those assets to cash or a liquid value. You can simply pass the asset and makes it much easier for the donor, and can also be better for setting the value. It doesn't have to be market driven as directly as if it were being sold at auction or something to that effect. The valuing of those assets ties into that, of course, for tax purposes, but that can be set by a number of ways and can be a benefit to the donor as opposed to selling it outright in an auction or a sale of some sort. And finally, they can pass assets to their heirs and the nonprofit organizations in the end without incurring these types of liabilities. So I'll talk a little bit about the types of plan giving instruments. Bequests and estate gifts are the most basic and generally where an organization will start with planned giving processes. A bequest or estate gift is really something left in the donor's will, and they would name your organization as the beneficiary or the recipient of that particular assets in the will. And just like somebody from their family, a child or a relative being left something in the will, your organization would gain the benefit of those assets when the donor passes. Could be a dollar amount designated, or could actually be a percentage of the assets designated in the will, depending on the donor's preference. Different category of gifts, the life income gifts. These are typically where there are securities and properties of that type that need to be managed and generate income or returns based on the type of asset it is. And they would generally be paying the income to the donor, and by passing this into a planned gift, the donor can continue to receive that income during their lifetime, but then designate the remaining value to be the gift to the charity or to other beneficiaries. So the type of life income gifts breaks down into various instruments to manage those. A charitable gift annuity is an agreement where your organization receives the gift from the donor during their lifetime, much like a cash payment or that type of thing, but receives the assets, but agrees to pay the donor a fixed amount each year based on the returns from that asset. So it's generally something that's going to be generating revenue. It could be stocks and that, but it's a guaranteed payment to the donor for the beneficiary of their life or the term that's set up from it. Trusts are a little different category. The charitable remainder trust is actually transferring assets to your organization or could be a different third-party administrator. And in the case of a remainder unit trust, the donor receives an annual payment or returns from that asset, but the amounts aren't fixed like an annuity would be. They can be variable, and in this case, stocks, for example, might return variable amounts on a given year, but the agreement would be to return some value of that during the donor's lifetime. At the end of the term, then, those assets transfer directly to your organization for your use or can be divided to other beneficiaries if the agreement states such. Similarly, a charitable remainder annuity trust, it transfers the assets to a third party, your organization or a separate trust administrator, but the payments to the donor are fixed dollar amounts. As with the previous annuity, it generates a constant stream of income or return to the donor in a fixed amount for their life or for a term that's designated as part of the agreement. And finally, there's a charitable lead trust, which is a bit of the opposite in that the donor takes annual payments or returns from an asset and designates that to go to your organization as gifts, but the remaining assets at the time of their death are not transferred to your organization but go to a designated beneficiary elsewhere. But in the meantime, you receive the annual payments or the ongoing revenue stream of those assets as gifts. So you can see there's quite a bit of variation, and this is not all. This is just some typical representations of the legal instruments and mechanisms for plan gifts. And it can become quite involved and certainly lengthy in legal description and legal agreements required to set these things up. A couple other types of gifts. Retained life estate, meaning typically property is given as the gift. It could be a home, it could be a farm, it could be other types of real estate or an asset of that type. But the donor continues to have rights to use that property during their lifetime. So in the case of their home, they can continue to live in the home and enjoy the benefits of that. But the home has actually been transferred to your organization as a gift and would not end up being sold or otherwise as part of the estate. Once the donor passes, that real estate or that property becomes fully utilized by your organization, which you can then repurpose and use for other things than the donor's occupancy, or it could be sold and the cash used for other purposes. And finally, the life insurance gift is simply designating your organization as the beneficiary of a policy. And in the meantime, while the donor is still alive, the payments of the premium payments on the insurance have to be made. And generally, that is the donor's responsibility to keep that policy in effect and alive. So there's lots of trade-offs between these sorts of instruments, but in the end, it comes back to donor benefits in terms of taxes and avoiding various payments of that sort so that those assets or those values can come to your organization rather than going to government entities. So in the case of a bequest, for example, it simply exempts whatever's being given to you from estate taxes. In case of a charitable gift annuity, they can get a tax reduction at the time of the gift on their income tax, and they can also avoid capital gains on the asset if it applies to that. Charitable lead trusts, similarly, they can take immediate income tax deduction for the donation and can also reduce estate taxes for those assets. Similarly with remainder trusts, you can get immediate income tax deduction at the time of the gift, avoid capital gains on the assets, and avoid estate tax savings. With retained life estates, they get immediate tax deduction when they donate the property, eliminates capital gains and estate taxes on the properties. And with the life insurance, they get the deduction of the premiums if the policy is transferred to your organization. So they're paying premiums on the gift, if you will, and that can be tax deductible. And of course, the assets or the benefits of the life insurance policy aren't taxed in their estate because that policy is essentially benefiting your organization. So there's no tax liability there either. Some important things to consider with plan giving. Some of these relate into best practices but are not comprehensive at all, but I wanted to give you an overview of kind of how to approach these. Gift acceptance becomes very critical, and I think organizations that have established good plan giving programs have started with setting up policies at the board level of how gifts are accepted and what types of gifts can be accepted. Just because real estate can be donated as a gift, your organization may not be in a position to handle a gift of real estate in that you would have to administer and manage the properties. You might have to handle incomes and returns from those properties during the donor's lifetime. You would have to liquidate perhaps those properties at the donor's death, etc. There's a lot of activity around some of these types of gifts. And if you're not in a position to do those adequately and correctly, you shouldn't accept the gift to begin with because it's going to create problems in the end. So these types of policies have to follow the maturity of the organization as well as the desire of the organization to handle various types of transactions. In the end, the acceptance policies provide discipline to your organization. It educates your fundraisers and accountants and other people in the organization as to how these things are going to be handled and processed. And in the end, it's really a benefit to the donor relationship because it makes things well understood and everybody being on the same page, so the donor's expectations don't get set at a level that can't be met. Another recommendation in best practices, if you're starting planned giving or have only begun to do types of planned giving and don't have the sophistication in place to handle everything, is to phase it in. Handle the bequests and the general designations and wills first, because those are very similar to outright gifts. It's simply that they're delayed and they're handled as part of an estate versus a direct transaction from the donor. But otherwise, they're very similar. You can receive those types of gifts in cash or even if they're assets like stocks and bonds and that, much easier to handle than some of the things that generate annuities and incomes and those types of things. Once you feel comfortable in handling the estate settlements and those types of transactions, you could move into the life income gifts where you're perhaps managing assets and certainly managing payments of various types, annuities or other types of income to the donor or designated beneficiaries. And finally, in the third phase, you would move into really full estate planning and working with the donor to create the best type of planned giving situation for them and their estate overall. And you can see that this would involve various types of expertise, not just legal and accounting, but estate planning in general requires a level of expertise that some organizations may not have right off the bat. So a phased program is a good way to come into the planned giving process. Solicitations of planned gifts, I think, is a little bit different. Certainly, you're convincing the donor of the importance of supporting your organization and the mission and objectives that you have, but it's not an immediate transaction. It's something typically that they think about for a while, they plan for quite a while, and really view as a legacy in terms of leaving something behind after their passing. So you don't want to sell a planned gift program as a product per se. You really want to sell it as an opportunity to fit the donor's needs and for them to make a bigger impact of their legacy by the different benefits that they can receive through planned giving. Conveying to the donor the different types of planned gifts options, I think, can be quite difficult. And the word illustration is chosen, I think, in the second bullet for a good reason, in that they really have to have a picture in their mind of how this really works. And it has to be an accurate and correct picture, and it has to meet both their needs and their I'm losing the word. It has to meet their needs and their expectations, and it also has to meet your organization's needs and expectations. So everybody has to be on the same page with that. Generally, planned giving is something that you're going to have a number of meetings on. You may have different variations of proposals and different opportunities that you work with the donor on over time. But the important thing is to ask for an appropriate gift at the appropriate time. Somebody in their 30s is probably not ready to do planned giving. Somebody who's far into the years may not really want to think about it anymore. So there's lots of variables unique to each donor, and your fundraisers have to be attuned to this, and they have to really understand the different types of planned giving options to create that relationship and that communication with the donor. You will definitely want your fundraisers working in this space to be very knowledgeable and very good at communicating your organization's values, their mission, objectives and the impact that these types of gifts can have, so the donor can see the importance of this type of legacy. And finally, you want to make sure that you track all the details around correspondence, communications, proposals, contact notes. Everything should be captured and a record retained, because these types of conversations can go for many, many years and could pass certainly through a number of different people in your organization. And it's important to capture those within your CRM so that you have that record and that detail to fall back on. Finally, there's administering these planned gifts. Even with just basic estate giving, you have to realize when the estate is being processed, when the donor passed and when the estate is coming into probate or that type of transaction. So you want to know ahead of time if possible. So you have to have somebody on staff keeping track of these. And you have to establish relationships with the donor's attorneys, executor, and other people related to the estate. During the lifetime of the planned gift, before it's realized, you're going to need to have various projections of its value and income to keep your balance sheets and income statements up to date. And that can be a little bit tricky too, because you're really kind of forecasting future values or current values of future assets, that type of thing. And with annuity streams and other variable returns, this can become fairly complicated. So that in and of itself, just keeping track of the values of these becomes a process in its own. You want to have a process established for accepting and transacting the planned gift when the time comes. Generally, people recommend that all notifications route to a central location so that it can be recorded correctly and proper people in your organization notified and brought into the process. Recording and details of contacts are very important. All correspondence and all conversations need to be captured to the extent possible. And you need to have these relationships set up with the person's estate attorney and executors and possibly even family members. So you have to know who they are and hopefully have relationships with them before you actually start processing the gift in the end. And with life type gifts and annuity type gifts, you have to have process for managing payments and transacting those funds back to the donors or beneficiaries. So it's a paying and accounting type process has to be added to that. Talk a little bit now about how the planned giving area in 1 supports these. Planned giving in 1 lets you designate instruments, so the type of gift that it is, and actually modifies the tracking content to match that type of instrument. You can track future values, present values, adjustments to values over time as the planned gift matures. You can also track payments against the planned gift, which may come in various transactions, and there may be open balances of what was committed versus what's been realized. We track that. We also track relationships to attorneys and beneficiaries, other people relating to the planned gift, so that you can know who these people are and establish those relationships. In the planned giving area, when you look at a particular donor, you'll see any planned gifts that they have that are active or processed, the history, if you will, in a browse area. Drilling down on that to get to the detail brings up quite a wealth of information. This is really just the first snapshot, not all, and in preceding screens here we'll show you additional areas of information in the planned gift. But this is where the basics start. You can tie the planned gift, of course, to a proposal, so you can track the contacts and various communications that were handled with that proposal against the planned gift. And it starts with selecting the instrument or the type of planned gift giving mechanism that's being used. So as we talked earlier, the various types of annuities, remainder trusts, life estates, insurance, etc. can be selected here. We also include a general category called expectancy, meaning that it's not one of these other types. It's simply a transaction that's going to occur as part of the will, where you're named beneficiary to receive an asset or a gift as part of the estate. Secondly, for trusts and more complicated types of gifts, we break down into the type. So here we can designate an annuity, a unitrust, and some others that I haven't mentioned here. And these are areas that you can expand as you handle different types of mechanisms for administering the planned gifts. You can increase or remove these types to meet your particular needs. Also track the actuarial, if you will. How is the term of the gift being tracked? And that can be actuarial life, life plus some term of years, and there's a field to capture those years, or simply for a term of years. That gives you the time period that you're being administering of the gift. There are lots of fields for tracking values. Planned gifts could have a charitable and a non-charitable component, so we track those separately. We have the complete value of the gift, but then we break it out into the charitable and non-charitable portions as necessary. We also can track present value, value adjustments, an accounting amount, which is what is posted to the ledger when the gift becomes active, and a campaign reporting amount, which may be different than the others depending on how you do your campaign reporting. Payouts also can be tracked. Amounts, dates, could be percentages, depending on the type of gift and how it's set out, the terms and the dates around those. We track a status of a planned gift, and generally your planned gifts are going to be in the planned state until the donor is deceased, at which time they can fall into a number of other statuses depending on your organization's process, and you can customize these as needed. You could have it passed to trust, be in probate, be in litigation. Mature, complete, and incomplete are fields that were added by one of our clients. We've included here as an example. And then final is intended to mean that everything has been handled and all transactions are completed, basically closing out the gift, if you will. And a number of other attributes around the planned gift. Particularly important is the revocable. By checking that, you're saying that something that's been set up into trust or otherwise transferred may not be permanent. The donor could change their mind, and that's a different situation and could certainly affect your projections and values of that gift in the end. We also can track things like confirmed, whether it's a contingent, documents, whether the foundation is the trustee or third party. These can be relabeled to some degree also, so if you have particular attributes that you want to check off here and don't follow these labels, these can all be customized to your process needs also. And you can see we can also track a series of dates around the gift that are meaningful to the valuation and timing. So that's the beginning of the tracking of the planned gift. Number of other fields here available. There's quite a number of user variables, which the bottom area of this screen are. And with user variables, of course, you can really customize these to your particular needs. They can be relabeled. They can contain various preset codes in drop-downs, or they could be text fields. We have dates. We have IDs for notifications. Lots and lots of things that you can personalize. You can see some of these will UV labels have been left unchanged, so you can see the effect of customizing here. But you can track various values, various dates, various attributes for notifying people in your organization, for understanding who's holding the assets, where they're at, how they're going to be transferred, etc. Lots and lots of ways of coding these gifts to meet your particular needs. And further tracking, under fund details area of the plan giving section, this is really what comes from the designation of the plan gift, or your fund, if you will. And the various attributes of the fund are brought forth here so that the people working with the plan gift can see what type of designations, purpose, the college it's related to, the programs it's related to, etc. Right off of the fund details without having to manage and replicate that information. Also track a number of contacts or relationships around the planned gift. These are customizable also. We deliver that's set up with these labels, but all of these can be relabeled. So for instance, if you didn't want to track attorney but wanted to track a different type of relationship, you can relabel, and these are simply IDs tying to other records that you can immediately reference from the plan gift to contact them, correspondence, see the history of their relationship with you, etc. And finally, the payments. As I mentioned earlier, planned gifts may be settled over a period of time as the estate is handled, and you may receive payments of various types at various times. These all come in and are tracked from normal gift entry, and as they're applied, the balance of the planned gift is reduced accordingly. Then the last area I wanted to touch on here, because planned gifts can be so varied and so many different types of processes handling around them, we wanted to show some examples of how clients have further customized attributes around their planned giving area to handle things like insurance policies. If the donor has left you a policy or assigned a policy to your organization, you first of all want to track that policy and make sure that it's staying in effect. You want to perhaps review annually the status of that. And this lets you, by assigning a user group to that purpose, you can track a number of fields that meet your particular needs. This is one example of insurance policy information, and you can see various attributes around the policy, who it's being paid to, the type, who actually owns it, the company ID relating to your contact records in your CRM, and a number of other fields, dates, and otherwise around there. Very powerful capability to add this into something like a plan gift, and you can track these on an annual basis or however your review policies dictate. Insurance statements reviews, another type of custom assets that were attributes that were signed around plan giving. So as you come in and make sure that the policy is effective, premiums have been paid, those types of things can all be tracked as needed. Insured individuals, beneficiaries of insurance policies, you can directly tie those to the plan gift. These are essentially people, and with the dates around them, they could come or go as beneficiaries. You could keep track of historics there also. And value adjustments. We track as part of the basic plan gift adjustments to value, but perhaps you want to see each adjustment as it's applied, the reason for it, notes behind it, the dates it happened, etc. So you can set up a user group for doing exactly that, the dates that it was handled on, why it was adjusted, what the adjustment amount was, etc. And that's kind of the basic run through. Shown here, we have kind of the summary of what we track and the important features of the plan giving area. And open up to anybody that might have some questions or other discussion. If anybody has any comments. Well, quiet group today. I hope this was informative. Plan giving is a very interesting area and certainly full of details and opportunities, and can make a big difference to your organization, particularly if it's handled well and if the donors understand the value of it. So I hope this gave you a good introduction, and If there's no other comments, that's all we have to talk about today. Well, thank you very much, and we'll see you at the next webinar.